Hello and welcome. Thank you again for joining us today as we continue learning how to manage personal finances and increasing our financial literacy. In some previous sessions, we talked about saving and investing, and today we are going to talk about borrowing as the third limb in management of personal finances. And borrowing is basically getting or receiving something from someone with the intention of giving it back after a period of time. And when you're returning that item or object to the owner, you could either return it with some interest or without interest. The types of borrowings that we usually interact with in our normal lives today, there could be more. Could be mortgages or house loans, personal loans, payday loans or salary advances, credit cards, overdrafts, for instance, Fuliza, hire purchase, Shylocks, digital loans, welfare club loans, and Chama loans. Why do we usually borrow, even as we interact with some of those types of loans that we've talked about? We could be borrowing to invest. And when we borrow to invest, we could be investing in property, in stocks, in businesses, among other investment ventures that are available in the market. And when we borrow to invest, we should make sure that the return on investment is way above or way more than the cost of the borrowing that we are taking out, so that the return that we get on the venture that we are engaging in is more than the loan and the interest and other charges cumulatively. Apart from borrowing to invest, we could also borrow to consume. For instance, when you borrow to finance education, when you borrow to finance a lifestyle, when you borrow to pay medical bills, when you borrow to pay staff salaries or to service personal cars, we could also borrow to buy food or pay rent or buy furniture. We could also borrow to finance a wedding or a vacation. These are consumption points. They are not investments. So we could also borrow towards this, but we must realize that these kind of objects are consumption objects and not investment, because they do not generate anything for us. What considerations do lenders make when they are considering us for borrowing? They look at the purpose of the loan that we are seeking. They look at the source of repayment, where will we be getting the money to service their debt, the age of the borrower. They look at the term of the loan, and of course this is looked at in view of the age of the borrower so that they are matched. They look at the credit rating of the borrower. They look at the nature of business that the borrower is engaged in, or the nature of employment and the terms of employment if they are in salaried employment. They also consider the character of the borrower, as well as the security being offered or proposed to be offered to secure the borrowing. However, it's not only lenders who should have considerations during borrowing. Even the borrower should make some considerations before proceeding to borrow. What is the purpose of the loan they are seeking? What is the source of income for them to repay the loan in case it is advanced to them? What is the cost of the debt, the amount borrowed, the interest and other charges loaded on the borrowing? What are the penalties applicable in case of default or in case of delayed payment? What is the term of the loan? And of course, just like the previous slide, this term of loan should be looked at against the age of the borrower. Then the borrower should also consider where they are borrowing the money. That is, the creditors that are considered for the transaction, as well as the security one is offering, so that you don't offer security that is way above or unproportional to the loan that you're seeking. Thank you so much for joining us and gathering more insights into financial planning for your personal life. We look forward to linking up with you again as you continue learning and gaining more financial literacy.